So what's up, everyone? Michael Manotskanian here, and I'm very excited for this special edition of the live weekly office hour. So typically people ask a bunch of questions in advance. I try to answer some of them, or I focus on a specific training and then allow for questions at the end. Today, it's pretty cool. We're starting something new where once a month, there's going to be a winner that is chosen from my Freedom Through Real Estate school community, absolutely free community for you guys. And you hop in there, you win the monthly competition. I'm doing a custom one-on-one hot seat with you guys, live and for everyone to benefit from. Got our first winner of the live hot seat, and we're going to bring him up shortly, and then we're going to help him solve his exact problem. And this is open to anyone. I don't care if you're the best real estate investor, the worst, I guess, I don't know, worst is weird, but like you're brand new, you're focusing on your first deal, you're just learning, you're analyzing. I don't care if it's, what you need help with. I've literally done almost everything that I need to, or I'll refer you to someone that maybe has done it a little bit better than me. But what I will do is I will help you, whether it's co-living, capital raising, creative finance, deal analysis, how to get started, how to make active income, literally anything and everything that you need help with. I will do my best to provide that to you. That is my commitment to you. Is I can't guarantee that I'll be able to help you with everything, but I'm going to do my best to guide you in the right direction, take in your specific situation, and then provide you my best feedback on what you can do, literally custom to you in your current situation. So we're going to be going through the very first hot seat one-on-one, and then we're going to do some Q&A. So we had people drop some questions in previously on Facebook, the Real Estate Freedom Roadmap community, all that good stuff. It's already there. Just real briefly for anyone that's new, Michael, who the hell are you? Why are we even watching this? I don't know. It'd be pretty random for you to watch this if you don't know who I am already. But I've gone from literally zero real estate in 2020 to over $25 million of real estate before the age of 30, and I'm fully financially free. What that really means is that my real estate portfolio makes more money each and every month than it costs us to live, which means I don't need to work and I don't work a job anymore. I retired officially in 2024. My wife retired in 2022 at around 27 years old. And we've gone all in on our family, continue to grow my real estate business, adding several properties, typically a quarter. And now I help other investors as well. So the main three things I focus on are what I call my 3 C's, my investment strategy, creative finance, co-living, and capital raising. All 3 of those have basically allowed me to go from 0 to 25 million in a very straightforward fashion. With that being said, I've got a free resource for you guys. So if you're newer in your investing journey or you just don't know about this, I want to share with you how you can get access to free tools, free education, free resources, all these other things that I wish I had when I was starting out in my investing journey. I do have some paid education programs, primarily the co-living community and my super investors community, but that's not really what I'm guiding you guys to. The vast majority of you guys should be taking advantage of all my free tools and resources, all things I put out there for free, the things I wish I knew when I was just learning 8 years ago, when I bought my first property 5 years ago, and all the things I've done progressively to grow and scale my investing journey. So here we go. So this is the Real Estate Freedom Roadmap community. I just dropped the link right there. You're more than welcome to join. It's totally up to you. There's a bunch of free tools and resources. I highlight this because what I'm going to be doing is I'm going to leverage, I assume, the free calculator that I provide in here to help out the winner of the hot seat. So basically, you can go in here. There's a bunch of free trainings, free tools, free resources, all that good stuff. But I believe we're going to need to go to Real Estate Investing and Analysis and then grab a free copy of the Super Investor Calculator, the free version, to help if there's a deal analysis kind of question or something along those lines. So that being said, I'm going to pull them up, and please take advantage of the free resources, all those awesome things, whether you're looking to buy real estate, be a capital partner, a bird dog, so make active income, just getting started. I'm here to help you guys. And hopefully between these live sessions, my YouTube content, and this community, that helps you just take the next step in your investing journey, wherever that is for you. Okay, so our winner, Devin Landers, my friend. Welcome to the channel. I got you unmuted right now. So just real fast, Devin is a member of my co-living community, right? Just very simple co-living freedom community. And he is learning about co-living investing. Or actually, you're not learning, you're actually doing co-living investing.
Yeah.
Joined after already acquiring a property. And so can you lay the groundwork for where you're at and what you're looking for and how I can provide some value right now?
So right now where we're at is we actually acquired the property, underwrote it fully, took it to several people to underwrite it and make sure that our numbers were good and everything was strong on it. And we've just been struggling in the capital raise for being able to raise the rehab and the
Okay, so this is not a deal analysis question per se. This is a capital raising question.
yeah.
Cool. And you said you've already done all the analysis. You've talked to lots of partners, but no one wants to move forward at this point.
Yeah.
You say it's a solid deal.
Yeah.
So my thing when it comes to raising capital is it's two parts, two very straightforward parts. There's the operator, right? The borrower, myself, you, we are the operators. People have to know, like, and trust the borrower, right? The operator, the borrower, before they're ever willing to even consider a deal. Then once they like the borrower, the operator, then it's the actual capital raising for that specific deal. So where do you think it's fallen off? Is it that they don't like the deal the way that you do? Are they considering the analysis differently? Or have you not taken the time or energy up to this point to get a few people that are know, like, and trust you?
So we brought in an actual experienced partner, Lance Riggin, and worked with him on doing the capital raise and tried to leverage his experience and everything. And just we're not quite sure. We haven't really gotten much feedback off of where things are falling off. We've had a few people that said, yeah, they're interested, they want to do it, but trying to get it all together in one pot to be able to go move forward and actually execute has been the struggle.
Okay, so I'll say you brought in the wrong type of partner, in my opinion. I know you were trying to raise money, so you brought in a capital raising partner. So what his role is going to be is to help you raise the money for the deal. But in reality, like, unless you already have your own operational success, your own experience, what you probably need is not a partner that can raise money for you. You need someone who's actually experienced in co-living, right? Because I assume that's the thing. We can deep dive into this a little bit more. I'll talk to you kind of what my super investor funnel is in 3 parts for capital raising. I'll lay that out at a high level so everyone always asking about capital raising can learn from that experience. So basically there's 3 parts of capital raising in my opinion. There is A is basically, so I don't have all the terminology perfected, but basically it's visibility, right? So it's getting people visible. They need to know who you are, that know, like, and trust. Then the next part is the deals, right? So it's how you present the information. Do you have all the info? And the last part is investor relations. So you close on the property. Now you're managing that relationship with a capital partner. So for the very first part, it goes into 3 little categories. Everything for me is systems, right? So it's not surprising that, I could probably pull some up, but just take me forever. So I go to the slide deck and find it. But there's those 3 phases of capital raising. That is my co-living system. The visibility, the actual conversion, right? Actually getting a partner, and the investor relations, that relationship management piece afterward. For the visibility, that's bucketed into 3 categories. At the top is you need people to know who you are. Who are you? Like, if they don't know who you are, they can never partner with you, right? So you're building relationship with people by first putting visibility out there. They need to know who you are. You need to be in investment communities, to be posting online. You need to do something that people see your name and know who you are. The next phase of that, right? It's not just visibility. Now we're filtering down. You're providing people value, right? Versus visibility, they got to see you. Even better now if you provide them value. Are you teaching people how to analyze deals? Are you teaching them about co-living? All that kind of stuff. That furthers your relationship with them. That nurtures your relationship with them, makes them more likely to know, like, and trust you. Because now they know you, but they can only like and trust you, right? Typically like you if you provide them some form of value, right? I'm never doing all these things for eventual capital partnerships and all that, but it's not surprising to me that the more hot seats and the more YouTube videos and tools and resources I put out there, more people want to partner with me. That is me providing them value. That is getting them to like me. People tend to like people that are honestly just trying to help other people. That's a very easy way to get people to like you. This is something I've learned in hindsight. It wasn't this, hey, let me just help people because eventually they'll capital partner with me. It came looking back to say, oh my God, all that deal analysis, all those things I've done to help other people, it's not surprising why so many people want to partner with me on deals. So we talked about in the visibility funnel, like the first phase of capital raising, visibility, right? Put yourself out there, value to get people to like you, and to trust you, you need alignment. That's the third phase. So all the people that you're providing value to, what you need to do then is basically get an opportunity to connect with each other. you need to connect with each other and identify alignment. Alignment of two things. This is where you're really validating, is there an opportunity where you guys are on the same wavelength, that you guys mutually know, like, and trust each other? Because you, as a capital raiser, should not partner with anyone just because you need the money, right? You should always do it because of the money, but also because they're a right fit for you long term, especially for giving up equity. You guys are in this thing for the long haul. You want to make sure you guys are on the same wavelength in both directions. So it's the two-way interview, right, of alignment. It's alignment of you guys as people, right? And then it's an alignment of the types of deals that you're trying to do. Does that make sense for the types of deals that they're trying to be partners on, right? If they're looking to be a private money lender and get a fixed interest rate return, but you're looking to have a private money partnership where you're giving ownership of the asset, well, there's no alignment in that, right? Does that mean you write them off and you never do deals? No, it just means when there is a deal that you need a private money lender, that's the right fit. There's alignment of the strategy with them. Or if they only want to partner on long-term rentals or multifamily or whatever, and you're doing co-living, well, there's not an alignment of the investment asset. Or there's not alignment if they want you to have some of your own money in the deal, so have some skin in the game, and then they put in the money. Another thing of alignment on the deal and the strategy, the person side, right? The know, like, and trust alignment, the person side, it's more just like a natural conversation. I have some things to see. Oh yeah, the last one on the deals is timeline. Like, if they need to put in $50,000 and they needed that back within 6 months, that's a very different scenario than someone who's going to private money partner and keep the money in long term to own together for a long period of time. So a big part of that alignment is also the timeline. So I have this all broken down. If you guys are in sub 2, I've talked a lot about this stuff. I was the leader of the capital raising semester in sub 2. I talk about this in YouTube. This is a big part of my super investors community, is literally teaching investors how to do all this, but not just how to do it, literally giving you all my systems, tools, resources, SOPs, access to my team, everything, so that you can do all this stuff for yourself and then get support on every step of the way. But like I said, more advanced. That's not for, like, Devin, you're actually in a pretty good position. You have deals, you're in there. It may not be the right time for you to do it right now, but I'm just saying, like, you're the type of person that typically we are working with in super investors, existing investors that are just looking to take it to the next level with systems, tools, resources, and support to take it to the next level. The co-living is a good piece of it, but it's the 3 core systems of deals, money, operations that really separates what super investors is for, right? So more experienced investors who are ready to take things to the next level, that's what that's for, right? Everything else I try to give away for free or really low cost in my co-living community. So I just broke down in detail, and it's all a funnel, right? At the top, you're gonna have 100 people that you have visibility towards. In the middle, right, you provide a value to maybe half of them, right? Like, you provide value to maybe half of them, and then you actually meet with like 10 of them. The end result of that funnel, everything is a funnel at the end of it, so just systems of funnels, 100 to 50 to 10 people that you get on a meeting. 5 of them, you're gonna have alignment of you guys are a mutual alignment, agreement with, you guys like each other and you want to do deals together. And then of the types of investments that you're trying to do, the investment strategy alignment. Now that I've given that whole breakdown, where do you feel is the break? Because if you're not filling the top or doing one of these steps, there's a break in that process. And the thing is, everyone wants to raise money when they have the deal, but that's why we say you're always raising money way before you have the deal. Once again, I didn't know that, to learn that the hard way through my own trial and error, similar to you. I have the deal and say, oh man, I thought it'd be easy to have a great deal. And I realized, well, the deal is one piece. The operator, they got to partner with me. They want to partner with me before they ever want to partner on a deal with me, right? That's where maybe the capital raising partner you brought in doesn't make a lot of sense, because it's not just the deal that they're presenting, it's do they trust them to do the thing? So where of that funnel, if any of it, do you feel things are missing? Visibility, value, finding alignment.
Probably between value and finding the alignment.
You're not meeting with people that have previously expressed, like, you're not, there's not an opportunity for you to meet with people. There's not, like, you don't have a process for how people can meet with you if you're providing them value, basically.
Yeah. Yeah.
Okay.
I haven't did any like office hours or done anything like that. I mean, I have tried to help others on underwriting stuff, and being able to leverage like your calculator and use it to help others out and say, hey, here's where your deal that you brought to me is falling apart, or where you might hit a bump in the road with it, but haven't really built out that pipeline.
Let me just simply break it. So of these 3 things, the thing that filters out is when you provide visibility, right? You're going to make posts, posts or whatever. 100 people are going to see it. The way you get the value is that the post is valuable. That filters down because everyone has a different definition of what's valuable. You can teach co-living, but someone wants to do multifamily. That doesn't mean anything to them. There's no value to that person. So that's the filtering step there between visibility to value. The filtering step, and this is where I might be confused, is you might be providing value at that point to people, but the filtering step to identify alignment is getting on a meeting with them, booking a call with them, whether you just get on like we have a whole processor form and it automatically links to the calendar, like it's just part of our systems. For you, when you provide people value, how are you then connecting the dots to meet with them or proposing, hey, I'm providing you guys value and how to analyze. Well, if you want to partner with me on deals, right? If you want to be a capital partner on deals that we're working on, here's how we do it. Fill out this form, send me a message. Here's my number. Here's my Zoom link. Are you doing that piece? That's the filtering mechanism for alignment. Providing value, how are you connecting with them to then see if you guys are on the same page? And don't worry if you're not doing any of this stuff. Virtually no one thinks or operates like this. I'm advantaged as an engineer turned real estate investor that everything I do is systems and processes because it all just makes more sense to me that way. And I realized that's what was holding me back from growing and scaling the way I needed to, was to create and implement stuff like this. But if you're not doing this, you're not wrong. Probably every single person watching this thinking, holy shit, this is a whole different, now it's a whole business with steps and processes and all that. That's the differentiator. That's how you go from 0 to 25 million in a few years, right? Like it doesn't happen on accident. The majority of people are not doing this. So don't feel like, hey, I'm not doing it, I'm way behind. No, most people are not doing this. Very few people, if any, are operating this way. That's exactly what the School Investors is for, is to help you plug in this kind of stuff. So don't worry if you're not doing it. Let me just see if I can help you bridge the gap on things.
Yeah, that's definitely, as far as I don't have any of those systems and processes in place. And that is definitely where it's falling short at and doing, because pretty much all I've been doing is just trying to fail forward.
Yeah, and that's good. That's literally number one. You cannot make progress without putting in the work to like failing forward. I think it's a little bit better. I talked about this in a couple live office hours before. You need to do action. You need to put in work because nothing works. No system, no process works unless you do first and foremost. However, there is a certain amount of education that I think is beneficial to make sure your work is efficient, actually making you the progress that you want. Like I said, it's very few places you can learn any of this stuff that I'm teaching you. Like this is literally what I've said here is probably already exceeds what most capital raising mentorships and communities and all that stuff teach on capital raising. They might teach you, oh, you have this deal. Here's what a private money lender, how would it impact it? But they don't teach you how to actually find people. This is the process that's missing for everyone, for the vast majority of people. And they just spray and pray when they have a deal and hope that it works out. Capital raising for me is definitive. It's not I hope it works out, but it's because of all this upfront work. So what you need to do, the simplest thing that you do, right? Because you don't have the super investor tools, resources, all the CRM and all those things that they get. What you need to do is understand to get from someone you're providing value to identifying alignment is to get them on a call. How are you going to do that? How are you going to even have an opportunity to get on a call with them? A call to action. Hey, by the way, I'm a co-living investor. I've got this deal. I'm looking for capital partners that want to partner with us on deals. To see if this is something that you're interested in, this is pause. You're not posting the deal and all this extra stuff. You're just trying to get on a call with them. Here's my phone number. Here's my Instagram. Here's my Zoom link. Here's something so we can get on a call and make sure this makes sense for you. In the beginning of that call, you're going to talk about who you guys are, identify personal alignment, and then talk about your investing strategy. Even better that you have an actual deal that you're raising money for. If there's alignment as people and investment strategy, then you can present that deal and say, well, by the way, we have this deal right here, right now. So what you need to do is when you are providing value, have a call to action, letting people know who you are, what you're looking for, right? You're looking to connect with people that would be interested in being capital partners, and then how to get a hold of you to schedule a time to connect. That's the bridge between value and then alignment, which is then identified during that call. Does that make sense? That's what you got to do, simply. I know it's going to take longer. You guys already own the property, all that stuff. We'll go into the details of the deal and all that stuff. I'll say the reason your deal is the exact reason why I teach most people not to do this type of strategy when they're starting out with co-living, because the gurus, the mentors, the people who make a bunch of money selling you these ideas, not to say that's what you did, but they're selling and saying how easy it is and how perfect and yada, yada, whatever. They're neglecting that it's really not. You're taking real estate investing, which is already difficult, and you're taking one piece of it. Like I teach very easy, low risk way to get co-living. People are teaching very complicated ways and acting like it's easy. There's no risk. Perfect. Get all your money back. But that's not reality. It's not how it works. They're taking something for me that's one simple process, writing 5 more things that could go wrong, and then setting people up for failure because they're not actually supporting them on doing that, or they're just sharing it as it's so easy, anyone could do it. And then you do it and you're like, oh shit, now the risk is huge, the timeline's tight, like all that stuff. So I get it. It is not ideal. We'll break that down in detail for people. They can understand exactly what I'm talking about with some more numbers. But get out there, and now that you're providing value, whether it's the analysis, sharing a spreadsheet, sharing analysis, sharing what you know about co-living, sharing the trials, the tribulations, like the good, the bad, all that is value. Then have a call to action explaining that you're looking for cap partners to partner with on deals. Here's how to get a hold of you if they're interested in connecting further. Full stop. That's what you got to do, and then get on a call with them. All right?
All right.
And go through the sequence, like I said, alignment of individuals, you guys as people, the investment strategy, and then the deal if everything else lines up. Sequence it in that format. I do a lot of things in 3s. It just works easier that way for me. I gotta probably get checked like mentally if there's like something wrong with me that I like 3s. But most things are bucketed into 3s because they make sense as a 3-part funnel in my head. Like, and once again, that's a funnel, right? Alignment of people, that's usually easier. Most people in this space have alignment as people to some extent. Alignment in the strategy, and then alignment in the specific deal. So another funnel. Everything's kind of just most people coming in, and it just whittles down to the end. All right. Let's talk about, for the people that the deals I've been presented to, obviously there was none of this stuff done, so you don't know if it's because of the deal, because of you guys, there's not alignment, like they don't know I can trust you. It's maybe that's not the right investment strategy for them, whatever. Do you have any feedback at all from any person that you presented this to that I can try to provide you some guidance on?
Not really. I mean, mostly it's been a lot of where the capital people that have come to us and said they're interested, it's more they've been, oh, my funds are tied up right now, but I'm supposed to get it back at this point. So I'll have the funds to be able to deploy in, like a month or so. Mm-hmm. And so then it's like, the month comes and then it's okay. Then somebody else that said they were interested. Oh, my money's tied up over here right now. I can't. So it's just been a whole mess.
Perfect. You explained a common situation. I'll give you my take on that. And I think it's perfect because a lot of other people who are watching this and now have watched 20 minutes of capital raising, these are my serious people still watching it, right? They're actually interested in raising capital for real estate, not the people who trickle in and out. For those of you that are really raising capital or trying to, this is going to be a common thing, whether it's already happened to you on deals you're trying to raise money for, or when you either you've gone through the experience or you will go through the experience at some point. And I'm telling you right now, there's two real branches I think of when I hear that kind of explanation. A, it's true and their money is tied up and they are not able to do that deal. Or B, it's not true and it's the softest way to reject you, but still maintain a good relationship. Does that make sense? Yeah. Like, it could either be true or not. At the end of the day, you're not raising the money either way from them, right? Whether it's true and the timing's off, you touch base with them and and say, okay, you said in a month, is this now the right time? Okay, well, there's these things going on. If it always seems like there's some excuse after another, it could literally be true, right? It could be. But more often than not, just understand it could also be a nice, soft rejection to maintain a relationship, a friendly way to say, hey, you know what? Actually, I don't want to do deals with you. Here's my excuses for why I can't do it. If someone's serious about investing together, right?
Yeah.
If it's really money ties up, there's not always an excuse, if that makes sense. So I'm saying either way, what matters for you is that that's probably not the right capital partner for you, especially if you're trying to raise the money now. The timing then makes it that doesn't work for you. Or B, if they don't want to partner with you, well, you don't want to partner with them, right? It's not going to work out either way. If they don't want to partner with you, it's not going to work out. So it's not the right person for this deal for whatever the actual reason was. It's hard at that point when they give that answer to understand what the real reason was, as opposed to, hey, yeah, I'm not looking to do co-living. I'm not looking to be a private money partner. This is too much money invested in one deal. Honestly, I feel like if you had more experience in it, then it'd be easier. So then you know what you're looking. Without that feedback, right? If they're doing the soft rejection, it's almost the worst thing for you, but it's the most likely, right? Most people do that. They don't say, hey, yeah, like think of dating, right? Oh yeah, I hate your facial hair. Your personality sucks or whatever, right? It's like, hey, yeah, I just got out of a relationship or whatever. I don't know. I've been married to my wife forever. We've been high school sweethearts. I don't know, whatever you guys deal with. There's the soft rejection to maintain a relationship, but it doesn't really benefit you on what you could do differently. Hey, yeah, I prefer men with more muscles. All right, cool. I got to work out then. Maybe I got to work out more if I want to work for this person. If they don't say it, it's like, yeah, it's not the right time for me. Well, it doesn't do you a lot of good on what to improve.
Yeah.
I'm going to assume your issues are you don't have enough people in the first funnel, the visibility, value, alignment funnel, that you're presenting actual deals to that have said, hey, yeah, I'm interested. Part of that is you didn't know to do that, right? So now you know. So you're one step ahead. Second, I think it might be the deal. So let's talk through the deal together. And I've got my spreadsheet pulled up. Or if you want to, I don't know, if you want to go through your spreadsheet, this could be a good way to publicly broadcast the deal to people that might be interested in partnering with you. But understand, I'm not here to sugarcoat or whatever. I'm not advocating. I'm not whatever. And I will quite literally tell you where I think things might be different than the way you see it. I hope you take that positively and constructively to adjust and pivot as you need to, as opposed to take that in a negative way. I'm not doing it to disparage you. I'm doing it to provide reality. I think there's too many people fluffing up information in the real estate investing space, the gurus and mentors, whatever. I'm here to be honest, and that's not always great for everyone, right? And I don't really care. If you want someone to make you feel good, I don't know, go talk to your mom or something. I'm here to help you guys on your investing journey. Actually, that's really funny because I know your mom and she's a nice lady.
Yep.
You want to go through that stuff together? And we could talk about high level or specifically. And this is the best way I could provide you direct advice. Although, like I said, I don't know if it's going to say, hey, yeah, I think it's not as great of a deal as you think. I actually know a little bit about this deal. I think it is a great deal. I just don't know what the capital raise is and kind of where we're at in the current situation. So I think the deal is great for CoLiving. I just don't know. I know the property is great for CoLiving. I don't know if all the numbers make it a great deal. You know what I mean?
Yeah, I'm just trying to see I'm trying to pull up, because I had me and Steve actually underwrote it on the CoLiving.
So do you have that calculator?
Yep, I am pulling it up right now.
Are you interested in okay, cool. And that's going to be very beneficial for other people. We might have to push back questions to the end, but I think it's totally worth it. You ready, brother?
Yeah, I'm dropping I don't know if you want to pull the link up on your end.
I think you can. Yes, I definitely do. I think you can send it. Do you see private chat? There we go.
Yep, I just dropped it.
All right, and I do have access to edit. Yes, I appreciate you. You're saving me a step here. Not everyone does. Do you want me currently to erase the address, or you don't care?
Doesn't matter. We've already got it locked up.
I'm going to make a copy of this instead. I'm going to make a copy for myself is what I'm going to do.
All right.
And I'm going to work off that copy instead.
Yeah.
I'm not going to validate your numbers and all that. Well, I'll show you what I'm going to do. Cool. I think I got rid of everything that I probably need to. Oh, you're using a slightly old version of the calculator, but I know you've been doing this deal for a while, and it's okay. Like, that's not an issue. So let's pull up the calculator. Present. Remember, guys, I have a free version of this calculator. It has basically everything that's here, except for the capital raising stuff. Literally, you can get it for free in the Real Estate Freedom Roadmap community. It's like one of the number one literally is the number one most downloaded calculator out there for creative deal analysis. And it allows you to not just do creative, but allows you to do all types of deal acquisitions. So let's provide a little context here. What is the play here? I mean, obviously it's CoLiving, right? That's the management strategy. What are you? So it's this traditional DSCR. So explain the situation of this deal to me.
So we bought it with PML, and we were going to DSCR it into the long-term debt. After we got part of the rehab, we were going to do the rehab in 2 different phases, because it's going to be a 12 unit with 11 baths. So you bought it with a PML. You bought it traditionally, or you bought it creatively with a PML? Bought it traditionally, or actually it's cash buyer.
So they funded the whole purchase.
Yep.
Okay, so I'm going to put some notes here. PML funded whole.
It's not showing up on the screen at all for me. I just have a black screen on this.
Oh, really? I think everyone else can see it. And we're going to talk, and I'm going to write stuff down. So you bought the property.
Yep.
With a private money lender who funded the full purchase cash. What was the cash purchase price?
Cash purchase was $250 plus closing costs, so it came out to a total of $268,000.
And then you added renovations in there? right? Because so let me just explain to everyone. I already know what the situation is. Basically, and I'm going to explain the context of this deal. This is called a BRRRR investment, right? You're buying the property cash instead of using their own cash, right? They bought it, someone else's cash, a private money lender. They funded it for a fixed interest rate return on the money. They bought the property. The plan is to buy it, renovate it, and then do a refinance on the property to pull money out to pay off all the initial costs of buying it, the closing costs, the renovation costs, whatever other, the carrying costs of the utilities and all that stuff. They're paying the more loan payments where all those costs, the refinance with a new loan is going to pay all that off in theory. That's a perfect BRRRR, and that means they own a property outright with no money in the deal. They never use their own money because they did it with a private money lender. Some people do it with a hard money lender. It's better for you that you did it with a private money lender because it's not as typically has not as much fees and extra work and steps. But I don't know the situation with your PML. Maybe it is. And so for the BRRRR to work out perfectly, the money you can pull out from the bank needs to be higher than your all-in cost. If you have more money that you can pull out than your all-in costs, you are able to own this property with no money in the deal. If it's the exact same dollar amount, he needed $300,000, and he got $300,000 from the bank, he owns it, and it's the perfect amount. There's no money left in. If he gets less from the bank than the actual money he has in, that means he has to leave money in the deal, right? So that's a cash in refinance. You don't actually leave money in the deal. You actually have to put money in to close, and we'll talk about that. This is now with the new loan and the down payment and all that stuff. If you're able to pull more money out than what you have than what you put in, you actually get to keep money up front. Okay, so this is yours, not to go this workaround way. Thank goodness. Okay, so the PML funded the full cash purchase, and your all-in acquisition cost was $268. That's all that matters. What was your loan from the PML?
Loan for was $268 as far as they were doing that, and then we were going to bring PMPs in for the rehab.
So what about okay, to clarify for everyone, he bought it and the closing costs were $268,000. But typically, to do a BRRRR, you have to increase the value of the property to get a new loan that is greater than your all-in costs, right? So your costs up front between your acquisition, your renovations, the carrying costs, in total have to be less than the new appraised value. But it's not just less than the new appraised value. You have to put a 25% down payment to the lender. So you have to actually be, all your all-in costs have to be like 75% of the ARV cannot be greater than, your all-in costs have to be less than 75% of the new appraised value. Let me explain what that means real fast. So if the property that they bought for $268 after they renovate it is worth $400,000, okay, the bank will give him, if it's worth $400,000, the bank won't give him $400,000 right away. They'll give him 75% of that because they want a 25% down payment. Okay, a bank is going to want a down payment, typically 20 to 30%, we'll say 25% down payment. That means the bank will physically give you 75% of that, or $300,000, right? 75% of the ARV, of the appraised value, to use to cover for whatever you want. You have typically to pay off all your debts. That's what that is. It's an extra way to do that. If it's done right, you're able to buy a property and own it outright with no money in the deal, and you have 25% equity. The problem is most people spend way too much on the acquisition, like the acquisition renovation cost, that what they get to pull out is not possible. Like it's what they're able to pull out is too low compared to what their all-in costs are, which means they have to leave money in the deal or pay money. So either they exceeded what they were planning on, or a common one is the after repair value, what they think the property's worth, their appraised value ends up being lower. It ends up being a lower amount than what they expected. That's how these things go wrong.
So we had talked to our DSCR lenders and got like pre-approvals on things, and they had given us a value of being able to refi it out at like, it was like 433 or 440, right
that's
around
the value, or that's the loan they would give you?
That was the ARV, and okay, so it would have.
And ARV is the appraised value. It's the after repair value, right? That's what your estimating is going to be worth. The appraised value is the same thing typically, but it's now validated by an appraiser, right? That's the number by the appraiser. Some lenders, like Devin's mentioning, will give you what they project it'll be worth if you do the renovations the way that you tell them you're going to do it. Do you know what the ARV is again?
I think we had it at like 450, 445, right around there.
Okay. That means they will give him around 300. If they give him 75% loan to value, that means they'll give him $337,500, and that can be used to pay everything. So his all-in costs have to be less than $337,500. Let me just quickly show you where this can go wrong for people. If his all-in costs are $300,000, let's talk about the net. That means he actually gets to keep 30. He gets to buy this property with no money in, and he gets to actually pull out an extra $37,500. He gets to keep, right? If his all-in costs were $300,000. If his all-in costs were the same exact amount as the loan, this is why I'm so glad I can show you. That means he gets to own the house with no money in, but he doesn't get to pull any money out. Well, in reality, for most people, their all-in costs end up being much more because they weren't projecting certain expenses. And now they have to actually bring in $17,500 to be able to buy that property. That's a cash-in refinance, as that's called, right? A cash-out refinance is if you are in excess, and a perfect BRRRR, like it's exactly on par, means you get to own the property, but you get no money out, and you don't have to put any money in. Another issue when this is negative, right, or another way this typically becomes negative is even though your all-in costs are $300,000, typically where people go wrong is the appraised value is incorrect. This is a little different in your scenario because the lender said this is what they'll give you, but typically someone thinks it's $450,000 going into it. Well, in reality, it's only $400,000, let's say $390,000, and your loan that you can pull out is $292,500, but your all-in costs are still $300,000. You have to put in $7,500, or the down payment, the amount of equity that we're going to require to keep in is more, right? They need a 30% down payment. So that means the loan is $273,000. That means you once again have to put more money into the deal to get break even, your all-in costs. Hopefully I didn't lose too many people there. I probably did, and I apologize. But the concept here is this is where people go wrong is their appraised value is incorrect when it's time to put your money where your mouth is, I guess. You thought it was gonna be worth $450, but now it's actually worth $400. Well, that's an issue, and that makes it sometimes impossible because if you don't have if this is really $350, you thought it was $450, you might not have the $37,500 down payment excess needed to get the deal done. And if you can't do that, what are you going to do? You cannot refinance out to the deal because you need to put the money in to get it done. If you can't do that, you're going to lose everything potentially if you don't have the money. That's where it's risky. It's one extra level of risk because now the way that I do deals is much more simple and straightforward than this. I do incorporate this, but I'm very good at what we do at this point where the risk of all these various steps is not as much. All we're focused on, because the next phase here is now you have to do a cash flow analysis, right? So now it's not just the acquisition that has a lot of variables because this is a variable. The appraised value can change. Your all-in cost can change because like the appraised value if you were just wrong. The loan amount, the down payment can change because they might require now 30% equity, right? Or they only give you a 70% loan versus an 80% loan or a 75% loan. Or your all-in cost, your rehab, your acquisition, your rehab, your carrying costs of the mortgage and all that. All these can change, meaning your all-in costs are higher, right? This one's the least likely to mess up, right? Because you know it typically up front from the beginning, but this is where most people go wrong. Their renovations cost more, take longer, right? If it costs more, that rehab costs you more to do, so your all-in costs are higher. Or your carrying costs are more because it took you longer to finish the project. This is where most people go wrong. The rehab typically has a much bigger impact than the carrying cost, but it just depends on a deal-by-deal basis. You have to account for all these things not going wrong. Devin, you did the right thing, brother. You got the appraised value from the lender, so you really minimize this risk. It's will they put their money where their mouth is, right? If they told you that, they might have. Did they switch up on you, or are they still validating this for you?
It's been a minute since I've talked to the lender, so I would have to go back and see.
Okay. This is another one. Is the percentage? They'll probably tell you what the loan to value that they'll give you is. What do they say? Do you remember? 75%, 70%.
It was the 75%.
Very common. So I'm going off experience, right, guys? That's why I can pretty much guess most of these numbers. So then you did a lot of this prep work where not everyone does. They'll assume this appraised value instead of talking to the lender first. You mitigate the risk on a BRRRR by talking to the lender first. Is how you mitigate the risk here. Same with the ARV or not the ARV. Same with the loan to value. How much loan percentage will they give you based on the appraised value? So you did that. The all-in cost, like we said, acquisitions, it's very difficult to mess that one up. The thing is, because you already know what you're buying it for. But that's when you decide, should you buy it for cheaper if your projections show that you're gonna have to put money into the deal. Your on cost will be too high. This, in theory, is your loan to purchase, closing costs, lender costs, right? All those kinds of things. That's your acquisition costs. You pretty much know most of that up front. The only thing that changes is the lender cost. And I mean, I have this broken down in much more detail. Oh, you know, I've got it hidden right here, but I've got it fully broken down elsewhere. I just want it simple for you guys. It's too many things to see. And the carrying cost, how long it takes you to do. This one's where most people go wrong from my experience. This one, or appraised value, but you did the right thing. You talk to the lender. All right.
Yep.
That's one phase now. Once that's done, you need to do your cash flow analysis to make sure, is this deal actually worth owning? Which is your income greater than your expenses? All we have to focus on, the way that I buy deals creatively, is the cash flow going to be fairly accurate? Is my income, based on my expenses, which are pretty much fixed, am I going to generate enough cash flow to justify the amount of money I have to put in the deal? The advantage for you is you might have to put less money in the deal once it's all said and done. However, all these things can go wrong and blow up the deal in your face with a birth, right? So, and you have to then also do the cash flow analysis, and you don't actually know what the debt payments will be with a BRRRR for certain until you actually get the loan, right? Because you don't know what the actual loan amount will be based on the appraisal. You don't know what your all-in cost will be. You don't know if you're going to pull money out. So that's still a big variable for you. That's where things go wrong. Where for me, all I got to focus on is this, and most of my stuff is already fixed, right? The income is a projection, which is the same for you guys, for everyone. Anyone, an income was a projection. That's why we focus so much on doing the proper analysis, proper co-living analysis. There we go. Oh, you're using the co-living version. That's why. The proper analysis for it and getting your data from places, mitigate that risk. And then your expenses, well, that's why you're supposed to break down your expenses into all the various categories, not do all the crap that other people do, which is a lot of basic assumptions and like, oh, 50% of my this and that. It's like, no, just break it down based on actual numbers. That makes sense for that market, for a property of that size. Yes, it's more work. This is how you set yourself up for success in the long term. Just like I showed you how much more work I do for raising capital, why I've been able to raise millions of dollars every time I need to raise money in a deal. It's the same thing. Either you do the work up front and enjoy the fruits of that labor over the long term, or you don't do the work up front and then you deal with the struggles that are associated with it, even though sometimes it can pan out fortunately for you, but it's not calculated. It's just luck. All right. With all that being said, where are you going? Is something going wrong here? Do you want to go through this phase real fast to get a pretty good understanding? Like your all-in cost, do you want to break that down? If you know the 450 and you know the loan amount will be 337.5, are your all-in costs, they're really just going to be the sum of these categories. You said this one is already, this was 268.5 or something like that?
Yeah, 268.
268,000. So at minimum, that's the cost there. You have to do a renovation to be able to get it to its maximum value. If you're going to operate as co-living, the best thing to do is renovate a property into the best single-family home version of itself, not as a co-living property, as a single-family home, just a regular house, a 4-bedroom, 3-bath house, something like that, 5-bedroom, 4-bath, something like that. But don't convert living rooms and all that stuff, because you're actually lowering the value of the property when you do that, right? That's what you do after you do the refinance, not before. I could do a whole 3-part series and all that for you guys later. This is in excess of what we can talk about right now in the next couple minutes. What have been your rehab costs up to this point before the refinance?
So the all-in, as far as to go to the full 12, but if we wanted to just take it to, the highest and best use for single family, looking at about 90,000.
Have you already started the rehab and all that stuff?
No, we haven't.
Oh, so you're waiting for more money to be able to do that. You got the money for this.
Yeah, we got the money to
do this.
Yeah.
And
to buy it. And then we were going to do, as far as the rehab and renovation into 2 different phases. So that was where we were going to bring the PMPs in to have the long-term, have people in with it long-term on us.
Yep. Okay, cool. So you have,
because overall cost for doing the full 12 units was like 150,000.
Okay. So to get it to its highest and best use for the appraisal, you said that's $90,000?
Yeah.
Okay. Well, I already see the issue here, right? Oops. I put one too many zeros. That's the issue. So once you do the renovation, and that's the renovation, that's the mortgage payments and the loan interest payments and all that as well. No, because you still have your PML interest payment, right? And this is adding every single month.
So the PML was going to take his interest on the backside once we refied.
And what is that, 12% or
15.
what percent? 15%. So for my capital raising guys, you can literally see it right here. So they have 268,000 at 15%. We're going to say monthly, even though you're not paying monthly. That is $3,350 a month of interest being added on. How many months of interest do you already have? Because that's further increasing your all-in costs.
We're about 6 months in right now.
Okay, so we're going to put this number times the PML interest, which was here.
It's going to be like 6 months was like 308, 200, I believe.
So you're at 6 months now, but by the time it's all said and done, it'll take you another 6 months maybe, or you think, to renovate. So it's probably going to be, because you got to project forward now. So your acquisition cost, this is what I'm saying. My other version of this breaks everything down into line items, but now I'm just recreating it so you guys can understand the theory, not just plug numbers in. That's a big part of understanding why I don't advise this stuff. Because if you did, your all-in costs are 398 to 200 right now to be able to do the refinance. Well, if you projected 3 months, it would have been 368. Well, if it's 12 months, 390, that's $30,000 more dollars you have to account for. That can make things worse and worse for you. So, and it's not the end of the world, because you can raise this money as a partner and solve that, right? But we'll talk about that. You need to understand your all-in cost first to be able to do that refinance at 450. So assuming it's done in 12 months, you do the refinance, you pay the interest, all that other stuff, and it's a $90,000 rehab to get it all done and appraised. That means you're going to have $60,700 that you're going to need to bring to refinance. All right. So that's at least gives you a rough idea. If it's done in 3 more months, it's a little bit better. But right now, right, this is what it's going to roughly look like for you. So with that being said, you need to raise the money. You need to raise this first and foremost. You need to raise the 90 plus whatever is the difference from what you previously raised, which was 268. All right, so equals, so money capital needed to complete project. So you originally raised the 268. I should have broke this down now, but you had 268, so you need all the rest of the capital basically is what you need to bring in. So equals this minus 268. So you need $130,000 basically. Well, we have that to complete project. To complete the project is this. So you need $130,000 to complete the project. Once you do that, you're going to have to refinance the property, and you're going to need an additional $60,700 to get that project done to actually execute on the refinance. This is why someone will not give you the money right now if you don't break this down to them. Hey, this is the plan. You project it's going to take 6 more months. We have all the quotes. We know it's going to cost this much. It's going to cost $130,200 to buy the property, to acquire the property, or to get it in the condition it needs to do the refinance, or to get it to the condition which you can do the refinance.
Yeah.
At the point of refinance, you will need an additional $60,000 to complete that project, right? So you're going to need an additional to refinance equals this amount, and we'll put minus, so it's positive, just for the sake of consistency. So you need $130,000 just to complete the project. Then you need another $60,000 to the refinance. You could probably raise this money altogether, $190,000, and tell them that yes, but $60,000 will be left in the deal, right? The problem with that is because you're doing co-living after, you still need to convert it to co-living. You still need to furnish it. You have carrying costs, reserves, all that stuff as well. Does that make sense? So you actually need even more money, and we can estimate this, but I hope this is giving you an idea. Once you need to get talking to people. Then you need to explain to them, this is the 3 phases. Phase 1 is I need this much money to complete this project. And then at the completion, we're going to need another $60,700, right, to be able to do the refinance, to put into the deal. So in total, you need $190,000 equals sum. In total, you need this much money to come from 1 person, 2 people, whatever. They're going to need money. They're going to need their interest. This person's going to need their interest. Or You tell them, hey, I'm raising money from a private money partner. Currently, we need $190,000, $900 to get through this phase, or $130 right now. We'll need another $60,700 to the refinance, right? And actually, all that they would need to do is keep this money in. So if it's two different people, you need this. This will actually be paid off. What am I saying? This will be paid off. You need this to get the project done. At the refinance, all you'll need to do is the $60,700. So we need to bring that to do it, but that'll also pay this $130,000 off. Does that make sense? Or no? Did I lose you there because I kind of misspoke earlier? You need this to get it to the refinance. At the point of the refinance, you'll need $60,700 to complete the refinance, but then you'll have to leave that amount in at the refinance. But this will all be paid off as part of this refinance, right? You're just going to have to pay the difference to do that because we've already accounted for that as part of the all-in cost. That's how we got this number. I forgot we already accounted for that there.
Yeah.
But you still physically need $130,000 to do the remainder, PML cost, the rehab, all that stuff. And the 67, actually, does this already account for it too? Really what you need is this amount to complete the project.
Yeah.
If that makes sense. To complete the renovation. And then you're going to be left with $60,700 after, because you need $90,000 to finish the project. This is why it's confusing, guys. This is why I'm telling you, don't do a freaking burr like this unless you're really good with this stuff. Like I said, this would be easier if I just used my calculator that had it all, but I need you guys to see it. I'll show you exactly what that looks like in a second after this. So you need this to complete the project. At the refinance, to refinance, the rest of the capital is paid off. So disregard this one. Unless it's two different people. Like you still need the money to get the product done, but this will be paid off. It's this, but you also need their interest, which is a whole other thing we got to calculate. You're going to need that, plus you're actually really going to need plus the amount interest. Oh, yeah, that's not how this works. Because, and we'll say what that will look like equals this plus this times, we'll just say 12%, and we'll say it's 6 months times 0.5. Don't worry about this math, guys. I'm not even explaining it anymore. Oops. 0.05. Half of 90,000. Oh, I already multiplied by 90,000. So you'll need an additional $6,000 of interest, right? So this is what you'll really need to leave into the deal if it's a PML. So your equity partner could either fund this up front right now, not get paid interest, but then understand they're going to leave $60,700 into the deal. All right? And they're getting 50% ownership for that or whatever. You're giving them a percentage of ownership. And what they're really going to have after 6 months is only this much or only this much left in the deal if it's a PMP. The PML, it's going to be this amount that needs to get paid off with interest. And then you're going to still need the $6,700 to get the project done, right? But that will cover this cost. The PMP is going to have to bring it all right now, and then what they're going to have is this left over. Let me answer if it is. You understand kind of if you went PML or PMP, like the money flow and what that's going to look like? No, honestly, so then I know.
Yeah, no, that's why I was structuring it the way I was with doing the PMPs and trying to have the equity. Yeah.
So you're going to instead say, hey, PMP, I need you to bring $90,000 right now, but in 6 months, we're going to do the refinance. It's going to pay off your $90,000 in a sense, but what you're going to have is at the end of that, you're only going to have $60,700 left in the deal for this phase, right? We're on the same page there. So they're putting $60,700 for ownership. Good. However, that's to get through the refinance. Once you're on the refinance, there's more costs to do the co-living conversion. So you're going to have co-living renovation. What's that going to cost you?
So the all-in, as far as that, we were looking to bring it up to the 12 units from our contractor that we talked to. He was saying like 150,000. So
wait, that's 150 minus the 90 or an additional 150,000?
No, 150 minus 90.
Oh, thank God. All right, 60,000 is still pretty insane. Where are you starting it from? I mean, that's a pretty insane level of renovation. If I were you, I would analyze, does it make sense to go that extreme? Some of your renovation costs might be way higher. For example, for people who have my co-living calculator, you'll see that the most common thing I do is between a $1,000 to $6,000 conversion. I'm taking living rooms, dining rooms, offices. I'm adding 1 or 2 walls and a door, right? And that costs me around $1,000 if it's just adding a door, because some places already have it. It's adding a door, or adding a closet, something simple if it already has a door, or I'm adding 1 or 2 walls to convert. So those are the most common types of bedrooms I do, because the ROI on that, the return on investment, is massive because it's so low cost and adds a lot of extra income. But if you're doing something like a garage conversion, or you're building something brand new, or these crazy extra types of renovations, which people advise you to do when they're teaching you the BRRRR model and all that crap, they just set you up kind of for failure, is that it's going to cost a lot more. And so they might talk about a perfect BRRRR to get this to zero, but now your renovation costs are massive on the back end, which still needs money. You still need money for that. You might save money here in theory because you're getting some of your money back, but then here you're going to spend a lot more. My strategy is much more low cost for the conversion, but we don't get the money back here. But that's the benefit of creative. It's usually lower money down, and it's lower. Almost always my entry costs are much lower, and I get it at lower interest rates and all that good shit, like all that way better stuff without all these extra steps than what's being told to you. But the reality of it is I'm very transparent and explain this stuff, or they'll say, no, this is going to be perfect. You're going to get $50,000 up front. It's going to cover all this other shit. It sounds good on paper, but they cannot actually put their money where their mouth is. They're going to show you real numbers where it's worked for them, nor explain, well, this stuff still has to get covered. You still have to pay these costs. So take your advice lightly, like take it with a grain of salt, even my stuff, unless you can validate it with numbers. If you're not able to, hopefully this has helped you to some extent, and all my trainings and all that help you to some extent. The whole point of being a successful investor is understanding this stuff. If you don't understand it, someone in your business needs to understand this stuff. I'm glad, Devin, you're tracking here. So PMP brings in $90,000, and that gets them 50% ownership. In theory, we'll just say a random number. They get equity.
Yeah.
The PMP leaves in at the refinance. At refinance, they're leaving in, assuming everything else is perfect, and it's 12 months. They're going to leave in $60,700 of this 90. So really, what they're going to do is they're going to get back the difference. They're going to get back. They get back around $30,000. But I assume you're not getting a 50% ownership just for this. You also need that to cover some of these, if not more money to cover some of this, right? So it's a two-part capital raise, essentially, for that 50% ownership, correct?
Yeah.
So you said here the CoLiving renovation is going to be 150. I guess I really didn't need a formula for this. Minus 90, so 60,000. This is why I can't do anything in 30-minute segments. I'm sorry, guys. I don't know what to tell you. Furnishing costs is, what do you estimate? Actually, I have it here. You said what, 15,000 or 20,000?
Yeah, I think I had it at like 1,500 a room.
Oh, you're adding 10 rooms. Okay, that's why.
Yeah.
A shit ton of rooms. How many rooms is it now if you're adding 10? Is it going to be 14
Well,
rooms?
No, it's a 4-bed, 4-bath right now, but it's 4,000, just over 4,000 square feet. It's got a 2,000 upper and a 2,000 lower. It's like 4,049 square
This
feet.
is what I meant. This could be a crazy good co-living deal from the cash flow side if all this other stuff can be done. It just, there's so many variables because of the BRRRR model. There's a lot of things that are uncertain right now. And the capital partner is going to need to understand that, hey, we might need more money. If we need less, great, we'll give you more money back. Or we might need more money. And that's part of this, like, hey, there's a threshold of $5, $10, $20, $30,000. And maybe you, Devin, or you guys as partners are going to have to bring in some of the extra money as well if it's wrong, because you still need to get the project done. You have $21,000 in furnishing costs. How long do you think it'll take you to do the renovation? I mean, 10 bedrooms is going to be a long time. It's going to be several months. That's not a 1-month project. That's another advantage of the way I do it. We're done with renovations in a month. We're done with furnishing in a week, right? It's all so fast, as opposed to dragging out major rehab, which costs you a lot of money, especially in your situation where you're paying interest on that money.
Yeah.
So let's just put 15,000. I don't know. That's 3 to 5 months, maybe, of the mortgage cost of this new mortgage. We don't know because we don't know what the new mortgage is. We'll estimate this 337.5. I think you have that here. For the mortgage, tax, insurance, okay, at minimum, it's going to be 3,200. Plus, you have some utility costs. Not going to be the full amount, but it's going to be a portion of these costs, which is another $900. So it's going to cost you between $3,500 to $4,000 per month. Okay. Equals 40, let's say $4,000 times, let's say it's a 6-month project, or at least a 4-month. I mean, let's go more conservative because it could take, 10 bedrooms is a lot. Potentially $24,000. And that's part of your reserves. Let's just add an extra $5,000 in reserves with a private money partner. And so your total co-living conversion costs are $110,000. My total acquisition, conversion, all those costs typically are between $80,000 to $130,000. And it's done way faster, right? With way less risk of things going wrong. If this takes you more, take longer, this number goes up, and that's going to make this even worse, right? Then you're going to need even more money from them. So then you have the co-living conversion, which is this $110,000. What this is basically saying is, yes, in this scenario, you can give them $29,300 back right? When you do the refinance, but you're going to need $110,000 really to do that. So in reality, or to get it to now co-living. So in reality, although they could get this back, they're not going to get this back. That just discounts the amount here. Does that make sense?
Yep.
What they really need to bring. So phase 1, refi, phase 2, co-living. Phase 1 is rehab, the regular rehab for the loan. What they need to bring here is $90,000. At the refinance, right, they're going to be leaving in $60,700. They're not bringing any more. Well, actually, they temporarily are bringing this extra money, but they're going to get it back to some extent. Does that make sense? They're going to get this 90 back, and what they're going to do is leave $29,300 of the 60 in there. Does that kind of make sense? Or that's how this is numbers count. It's the difference between these two. They're bringing this up front. They still need to physically bring this money. They're just going to get this paid off, and all they have left over is they get back. So it's really the opposite of that. So phase 1 is the rehab. They need to bring that at the refinance. They need to bring $60,700. What that's going to mean is that this refinance allows this to get paid off. So now this value is going to go to 0. Okay, this value is still going to stay there because they're not going to get this money back because that money, well, okay, we'll say yes, it is going to be that amount. That stays. Boy, I hate bird deals.
Yeah, I've learned my lesson on this one.
It just there's too many things that can go wrong, and even just this process now because you didn't have the right numbers from the beginning. This is why it's so fucking hard to raise money for it because it's very hard to explain logically. Like I'm pretty good at this shit, and we do this stuff. I'm not really in the situation where we have to put in more money and all that stuff. Your saving grace is okay. Well, we're going to own it outright, so we can give up equity if they bring in the money, and as long as and then we didn't even talk about then the returns have to justify the amount of money they're putting in. We're going to assume your numbers are right in the bottom, and I'm going to tell you very quickly how that works. They bring this in, that gets paid off at the refinance. They're also bringing this in at the refinance. They're bringing this early. They're bringing this at the refinance. So they're bringing $150,700 total. Okay, but this is going to get paid off after refinance, and they're going to be left over.
So what we were trying to do was go in and raise
the 90. I see. Sorry.
Raise the 150 and have them in as PMPs. Refi out the PML that put in the 268K, so he's completely gone. And then they're in for the long term as far as the 5 to 7 year hold.
Okay, perfect. So PMP phase 1 is this amount. And that's because you're doing this is why it's a little more difficult with a PMP doing all of it. A PML, it's okay. We know it's this. But remember, this is without the interest. So it's really going to be more than that. It's without the PML 150,000 that's needed. Right? Yeah. That's going to be a lot of interest on that too. And that's a lot of money given the variables, but equals the sum of these two. So yeah, PML plus interest. So it's this times, let's just do then the interest, let's just say 12% times half of that because it's 6 months time. Yep. So 12% times half because it's only 6 months. And then we're going to just add. That's going to be paid not by this guy, but by this guy. So refinance. They're going to bring this money plus co-living conversion, which is this money. There you go. It's a little bit easier now. All right. So you need someone, a PML, to bring you this 150,700. Your new PMP that's getting equity, right? 50%. I don't care what the number is. I'm just It's an equity. They're going to bring in the interest to pay back this guy, right? They have to pay the interest on this, right? Good there. They have to pay the interest on this, right? We're on the same page there. If this is from a PML, there's interest that's going to be owed to that PML. That's not accounted for here for this 150, right?
Yeah. So the only PML that we were going to have in the as far as the thing is the original upfront purchase price. So you're
not going to raise for because you need another $150,000 just to complete the project.
Yeah, and that was going to be the PMP. The 150 was just.
That's kind of what we were doing earlier. Okay.
Yeah.
So they have 150. Okay, from phase 1, right? And I said, in reality, they're bringing this much money back. They're bringing this much money into the deal, but in reality, they're going to get this 90 back, right at that phase. In theory. But that 90 they're not going to get back. I'm assuming it's going to cover some of these costs, right? Because at the refinance, this 90 gets paid off as part of the refinance. It's part of the all-in cost. That makes sense?
Yeah.
I'll let you noodle on that. Just draw it out, literally with a pen and paper. Just draw it out. Just understand the flow of money. They're going to bring the money to complete the renovation. Then you're going to need another $60,700 in the deal, right, to pay for this, to do the refinance. If we want, we could just erase it from here. And it's going to be the
So
same.
when we did the refinance, we were going to just cash out the PML that put up the 268, cover his entire interest. So that was at the time, as far as the 15%.
308,200 is what we're expecting.
Back to him.
And then the PMP is going to bring this $90,000, right?
Yep.
Assuming that's the case, you're going to need $60,700 for the refinance brought in to be able to do the refinance. Or this $90,000 is not accounted for as an all-in cost, which means really what they're doing is that they, like, because I can't just say the net. You have to know how much money they physically have to bring. They have to bring $90,000 first. They have to bring $90,000 for the refinance. And then what they're going to leave in, right, is this net.
Yep.
Because that $90,000 in theory is paid off at the refinance, but there's still another $29,300 that needs to get paid, right?
Yeah.
So what they're really doing is they're bringing this up front, and then at the refinance, they're leaving in $29,300. Does that make sense?
Yeah.
Okay, cool. So I'll get rid of this because this is for a PML. So with this scenario, PML leaves in $29,300 at the refinance. Then you have the CoLiving conversion cost, which is another. Said this was $60,000.
Yep.
So they have to bring another $110,000 after the refinance. So their total PMP cost is actually this, what they're actually keeping in the deal long term, right? We're on the same page there, but they first have to bring 90. They're going to get the 90 paid back at the refinance in theory and only leave 29,300 of that in the deal because that's gone now. I mean, 67,000 of this is covered by the money from the refinance. So what they're actually bringing in this phase, am I just doing the same things over and over again? I think I'm doing the same things over and over again. Because this money out will be utilized to cover some of these costs. F12 minus that. Yep, that's how much you'll have back separate from that. The CoLiving conversion and the PMP, what they're bringing in, I think it's this. Whatever. What they're really going to be responsible for is around this much once it's, well, that's weird because that's exactly the number I had up there. I think what they're really going to be keeping in is around this amount. Does that make sense? Kind of, is that kind of what you're at, or is this what you needed specifically to help with understanding these numbers? This is why I hate this stuff. There's like 4 parts and we didn't even do the cash flow yet. To even understand if this is worth it. I'm going to assume a 12 to 14 bedroom property, it's probably worth it, but we're going to know that shortly.
What I underwrote as far as for the cash flow and stuff, if you want to jump to that area.
Yeah, so let's do, but understand this is how it's going to work, right? They bring this money to get this first phase done.
Yep.
When you do the refinance, they're going to leave $29,300. They're going to have to leave that in the deal. You guys are going to get the rest back, the 60-something thousand.
Yep.
You're going to get it back, but that's going to transfer into covering some of these costs. They're going to cover the difference of that. They're going to need to cover that different cost, which is this $49,300. So in reality, they're bringing in $160,000. Does that make sense? This is actually accurate. I know this for a fact.
Yeah.
They bring in the $90,000 to do the refinance. When the refinance is done, well, you guys are going to need to leave money in the deal and actually temporarily cover it. What they're going to leave in is the difference, the $29,300, because this is not going to get paid out to them, right? That's just happening. Oh, no, I'm wrong. Because even though they're doing the $90,000 and they're funding it, well, you're actually spending that money. Fuck, this is why this shit sucks. You're actually spending that $90,000. So that money is being spent. It's not like you're getting that money back. They will have to bring in an extra $60,700 at that phase as well. So now this math is off, but if I do that, it'll fix it all. So actually, they need to bring an extra $60,700, and then you have an extra $110,000 for the conversion. So in total, they bring in this 90, which is not, that money has to stay. It's part of the all-in cost. Then they have to leave an extra $60,700 They have to bring an extra $60,700 to do this, to do the refinance or refi. So it's not leaves in.
And this is why it's to partner with the right people.
Yeah. Well, whoever you partnered to raise capital, they should have fully fleshed this out for you and understood it. We're doing this literally on the fly, and we kind of got to the point here where it's accurate, but it's difficult unless you understand the full context, and we're just kind of piecing it together. PML, PMP, whatever. PML would destroy you. You cannot do that. You cannot add more interest with this entry cost. It's just not going to. This is why I wish you did my co-living community before you did these deals or this deal, because this is literally, I tell people, you're better off investing in education sometimes than investing in a deal if you need to understand what you should and shouldn't be doing. It's great, Mike. Thanks. On Monday morning quarterbacking, like, it doesn't do you a lot of good, but this is why. This is a perfect example of why. It's not that it's going to be terrible, but this is how much money needs to be left in the deal from a PMP. They're paying it in phases. Day 0, refi date. So that's around 6 months later. And then this is co-living conversion date. Like I said, I could have just put numbers in a spreadsheet and gave you all these answers, but I wanted you guys to understand the logic. It took a little longer to get there because I didn't understand the full sequence here. But and that's 12 months later, right? No, that'll be actually right at the same time as the refi. So at the refi, they're going to still bring that money because once you refinance, then you're going to do the co-living conversion. You don't need all that money up front, but they can do it in phases. But in theory, this is when this amount will be needed up front at the refinance, and then you're going to need this to then do the rest. So someone needs to have a lot of money or multiple people to do this amount of capital raise. All right. So if there's the money in, it's very easy. So we're going to skip a lot of the stuff here that you have. Am I using my own version? Yes, I'm using my own version here, which is great. So all this other stuff, your entry costs are irrelevant here right now. This entry cost is irrelevant because it's already accounted for in the other stuff. So what we're going to do here is we're going to just change this to this value right here, and that's it. Why is that irrelevant? Because we've already accounted for the down payment as part of our thing. We've already accounted for all that stuff. Oh, this purchase price is the ARV of the new loan, which is this amount. The loan amount is then, okay, what, you think it's a 7.5% interest rate? Because all we need now is the cash flow stuff.
I think interest rates have been dropping, so I don't know where they're standing right now. But
well, it's going to be 6 months from now, so we don't know. We'll just stick with 7.5. I mean, it drops and then it goes up. Like, it was down for a little bit. It peaked for residential in the high 5s, and it's already back in the 6s. I'm not going to speculate on anything right now. Everyone does not understand how interest rates work. Very different than the 10-year Treasury bond, whatever. That's a whole other economic discussion. With that being said, let's assume then this is the amount of money needed in the deal. We're going to just follow very quickly what you have here. You have 12 rooms. Is what you think it's going to rent for. That's how much income you're going to produce with these 12 rooms every month. Your expenses have your mortgage payment here, right? Your new loan payment, which is not count for your cap partner or anything. It's just for the new loan. You have the tax and insurance. I'm assuming these things have been updated. This is all on you to make sure you're right there. Oh, one thing you didn't account for potentially is you're going to probably need more money at the refinance for more closing costs. That's probably be another 5, 10, 15,000. You can get that from the lender. You're probably going to need actually, let's just say $12,000.
Okay.
Costs. You know what I'm saying? Because that loan is going to have closing costs. Not to buy it, but to refinance and have its own. It's not going to be a ton, but we're just going to estimate a few percentage. I mean, you would do a percentage of the loan amount. Like, this is more accurate way. We'll just say 0.03, but it really depends on your lender, how much they're charging for all these things. So 3% of that, which this number is around $10,000. See, to roughly estimate that. So it's kind of the same thing.
Yeah.
So you're going to need 270, let's just say 275 to be safe. Whatever. And this is assuming everything else works on the timelines we estimate. If you were wrong and you raised too much, great. You can pay some of the money back. If you're wrong and you raise too little, you guys are fucked because you're literally telling someone you're going to do this deal. These are returns based on this money amount, but now they have to bring in more. Not very nice to do. I'm not saying that doesn't happen, right? The numbers are not always perfect. It just understand that it's better to be a little bit more cautious than the opposite, which most people do, and then you end up in the wrong situation. I've had to learn that too, right? Don't raise under ever. Don't even try to raise the exact perfect dollar amount, assuming perfect scenario. You have to have reserves and all that stuff accounted for. You think it's going to take 4 months, maybe have the carrying cost for 6 months. You're giving them more ownership to justify the returns for them when you do that. So you're kind of shooting yourself in the foot. But what you're doing is you're protecting your partner, which is better because they're not going to have to bring in more money unless something really crazy happened that you cannot have accounted for. You've done a lot of the things that you need to account for with getting the appraised, getting these quotes and all that stuff. Now it's overseeing the project, ensuring these numbers are right. These are very high, so I'm assuming these are fairly accurate. All right, income, your expenses. This is pulling from your loan, the new loan, right? This is not, yep. The taxes, insurance, going from there, you have an extra $100 for additional insurance costs. You don't need that because this $500, I'm assuming $400 a month is already co-living insurance. You're to account for that. This is like if you're doing like a regular house that you're taking over sub 2, you're gonna have to account for more. Because a homeowner's insurance is much cheaper than a co-living insurance. That's what that $100 kind of does. You've already done that here. You don't need to do that.
Okay.
Your utility costs, I think $930 might be a little bit wrong based on a 12-bedroom house. I would almost go $100 per room on the higher end, or it's really not that. Like once you get to this point, I think it's going to be closer to $1,000 to $1,200.
Yeah.
These ones are going to go up a lot more. Garbage and internet are the same, right? That's not going to change, but these two are going to be a lot more, right?
Yeah.
It depends on your market and all these. These are just rules of thumb, right? You can only rule of thumb so much. You got to validate the things, but you need some numbers to be able to analyze. Whether you do $100 per room or 10%, it's roughly the same. It's $70 difference. You can do $100 per room. You know, if we do 10% of 12,000, it's 1,274 versus 1,200. I'm going to go higher end on this to not mess up your partner. So putting in so much money, you really don't want to be off here because that's a lot of money to be invested in one deal. Landscaping, house cleaning, you have to determine if these are accurate. You stuck with the plug and play numbers, depending on what you're going to do here. I don't know how big the lot is. I don't know, what the house cleaners are going to charge you. I don't know. That's up to you. The pad split fees, yada, yada, whatever. Vacancy at 15%. Oh, so you went higher than the area probably because it's further from downtown. It's further from center of Atlanta. Is that why?
Yeah, I think with what it was showing on Pad Split's website on the overall Pad Split owners map, when I was looking, it was showing like about an 85% average. So.
Yeah, because it's probably not in like a core area right now. Maybe it'll change in the future. The only thing I'd maybe a little bit wiggle room is $500 a month is $6,000 a year. That's pretty good reserve set aside for a property, but you're gonna have a lot of people. So, that's when we go a little bit lower as a percentage. Instead of the 10% for long term, so we go 5% for co-living, 5 to 6%. Once you get over like $500, $600, $700 a month, it's almost too much reserves just being set aside. But it's all right. You have your 12,000 here, your 9,000 here. That's with your reserves accounted for. Your cash flow is around $4,000 a month. How the fudge does that make sense? 12,000 minus 9,000. Is that 4,000? Why is this math not mathing in my head right? That doesn't seem right. Expenses are here. Property management is here. Reserves. Oh, this is hard coded. See, bro, I'm too good at this shit. I'm too good with numbers. This is wrong. I don't know where that number came from, but it's wrong. It's hard coded. Maybe I mess up the formula. I don't know when you guys are grabbing that version at that time. 3,258 because 12 minus 9 is 3, right? It can't be 4. That doesn't make a lot of sense. That's what we can do right away. Okay. So even though they're bringing in a ridiculous amount of money, $275,000 to get this deal done, the deal itself is going to produce a lot of cash flow, and they're going to have the deal itself is going to have 14.2% cash on cash return. For me, I'm looking for 15% or higher, usually 20% or higher. But that's me, right? We all have different standards for deals. I've got a lot of deals, and I'm not doing all this extra work for deals. But this is the funny part, right? You did all this extra work for a burr to have less money in and all that, and at the end of the day, you're putting in $270,000 to do the deal, or $275,000 to do this full deal, where, like I said, on average for me, it's $80,000 to $130,000 per deal. So you did all this to put less money in. Right? It's not your fault. It's the way it's taught to have less money in the deal. But in reality, you're putting in, I could have bought 2+ houses, 2.5 houses with that same amount of money. Yes, you're making solid cash flow, but I'm making $1,500 to $2,500 a month in cash flow, and I can buy 2 or 3 properties. So my total cash flow is better. That is calculated by my cash on cash return. That is saying how much cash flow do you generate for every dollar you're investing, right? And it took you way more time and effort, 12 months to generate anything, and all this risk and things can still go wrong to generate lower cash on cash return than what I would like, or even just the strategies I recommend. It's not your fault. It's the strategy. Why my strategy is so much better, the turnkey co-living conversions with creative finance, so much better than what's being taught as this burr model or a full development or whatever, because you're putting in way more money for usually worse returns. The cash flow looks better on paper, It looks better on paper. And you do have equity in the deal, but that doesn't mean you're getting any cash flow on this. And really your equity is negated. Whatever 25% equity you had here, $100,000, negated by the $300,000 you had to bring into the deal. All said and done, right? So it's really not. I say that for anyone else who's watching, why I'm all in on my strategy of creative, co-living, low-cost conversions. That's the number one way, almost exclusively how I'm buying deals, especially in this high interest rate environment. And in reality, with co-living, you still have to pay for the co-living conversions. It negates whatever benefits you got to lower the cost of the loan when I can buy properties for much lower down payments, typically $10,000, $20,000, $30,000, $40,000 for the acquisition. All right. It's still not a terrible deal. It's not a terrible deal at all because people are happy for a long-term rental if they can get anything positive in $100 cash flow. So it's not like it's impossible. You're just going to probably have to give up more than I would, not only because you have less operational experience, less cap raising experience, but because the deal is not as juicy as my deal, right? So it's not a no deal for you. These are my standards. You can change your standards, right, as my minimum standards. Great on cash flow, but yes, because of the amount of money that you put in for a down payment and all that and how much money is being added to the deal. That's why you can't just look at cash flow. You have to look at the entry cost, or really the cash on cash term. Takes this times 12, the annual, divided by the entry cost. That's what this is. This is the most important metric above any other metric ever in understanding how your deal, is it a good deal? Apples to apples compared to all other deals. All right. So for you on the capital raising, if it's 50% ownership and cash flow, they're looking at they bring in $275,000. They bring in 50% of, or they bring in 275. They get 50% of the ownership and cash flow. You did the deal. You do all the work. You're the one who's going to operate it, rent, do all that stuff for it. You're overseeing all of it. They get 50%. You get 50%. Their cash on cash return for this investment, their portion, their 50% of the cash flow, divided by their $275,000 invested, is a 7.1% cash on cash return. Right? It's 50% of what yours would be if you brought the money for the deal, because they're only getting 50% of the returns. Make sense? They're still bringing in 100% of the money, but they only get 50% of the returns. All right?
We had actually bumped it up to where we were doing 80-20 split.
They would get 80?
Yeah.
I would say so, because I'm not saying this is good or not. I'm saying I can raise money like this, but I'm a lower risk investment, and my deals are lower risk. I'm a lower risk operator because of my experience, and my deals have lower risk because all we're focused on is this part being accurate. That's all we need is this accurate, and there's a lot of data, and the more experience you have, the more accurate these numbers are. Well, in your scenario, your deal with these bird deals, you have a lot of variables that can change things drastically for you, right? Like if this ARV is now $400,000, well, actually you needed $300,000 to get this deal done. So what are you guys going to do when that was wrong? You know what I'm saying? Like there's a lot more, not you as the operator, that's one thing, but the deal itself has a lot more variables, a lot more risk. Why I don't recommend going that route. So for you, yeah, I mean, I can usually raise money close to this amount, this return, 7% cash on cash, 15% ROI. That's actually pretty standard for me, but the percentage of ownership cash flow is different. My deals are typically better, like they have a higher return, so I don't have to give up as much. I still get them the same returns. For you, in this scenario, I would just try to get this shit done and make it a learning experience and get everyone happy, which means give up a lot of value to your partners. I would very much agree with going this route and saying, hey, this might adjust based on these things. If it does, we will give you, if for every $25,000 more, as long as you can provide that, we'll give you an extra 10% or whatever. I don't know. Like if this went to $300,000, obviously their deal returns are worse now, right? They might say, okay, that's fine. We'll give you a wiggle room of $25,000. Or if it goes up that way, we'll have to give you an extra 90% to kind of get you to the same amount, the extra 10%. Does that make sense? You can put in those contingencies because you're not for certain on your numbers, because you can't be, because it's the burn model. There's just a lot of uncertainty. Cool?
Yeah. Is there a way we could possibly get your contractor out there and see what you guys' thought process on this property is?
Potentially, but this is more than what he does. Primarily, the reason why we work so great together is we're doing typically just this phase and not of this amount. So he's a contractor that works real great with us, but it might not be the type of contractor you need to do your project. Does that make sense? Because you used to doing projects in a week or two, like in a month, bang them out pretty quickly. So yes, I can connect you with that and see if it's a good fit for you, for sure. I mean, you're in the co-living community, so that's exactly what the purpose of that is. I can try to connect you guys and get you guys support. And obviously you get to take part in our lively support calls with my project manager and all that, take things to the next level and help you out.
Yeah, because if there's a way to minimize the overall cost, and possibly take it up and keep the returns at least high enough.
And that's the cool part, right? If you lower this cost, there's less money needed up front. So if this goes down, that's all you can really do, assuming these are accurate, is ARV and all that.
Yeah.
If you can lower this by 10%, so let's say 90% of it, and you lower this by 10%, that means you have $20,000 less you need to bring into the deal. That's awesome. $20,000 less from someone else. That gives you more wiggle room, assuming this number, oh, this is F19. Oh, so it's based off the rounded number. Okay. Whatever, because I rounded it up. Actually, for this instance, who cares? We don't need to round it up because we just need some rough numbers. That can make a pretty big difference for you, right? The returns are higher. I think you're going to get the show. Oops, I broke it. I broke the code. All right. Simon says zoomed in. I want people who are watching mobile to be able to see it. Shit, dude, that made virtually no difference. Oh, no. It's still the wrong number. Okay. 1.8. I was like, that's crazy. It's the exact same return. Now you're at 15%. Much more ideal with what I like on my deal as my standard. Remember, we have some reserves built in and all that too. It's not like, oh, best case scenario this happens. This is assuming your reserves and all that. Like we put reserves for the carrying, we put extra, it's only 5K, but we put some carrying costs. We did all these things. We said it's going to take 12 months, yada, yada, whatever, or 6 more months to do each of these things. So if it's all done faster, it's better because that means your cost, this would be lower, right? If it's faster, right? All these things benefit you. Now it's even lower and lower. I'm saying play a little more aggressive with your reserves right now, just in case. But yeah, get a couple quotes, make sure they're accurate, and they're not just giving you fluff numbers. But some people just give you fluffy numbers just to get you to to choose them. That's a big part of understanding how to oversee contractors, which is another huge issue with doing the BRRRR. If you're not used to doing that, you're not used to having someone do a full gut renovation or a 90K, 100K renovation, and especially if you're doing it remotely for the first time, shit, a lot of things can go wrong. Someone can take $50,000 of it and bail, or get $80,000 in. Hey, actually, it's going to cost another $50,000. If you weren't managing that project well, these are the risks involved with that. This is why BRRRR is also more difficult. It's very hard for someone to mess around and mess up too much on the CoLiving conversion, the way that I teach it. They can really mess up a garage conversion, and instead of 20,000, it's 30,000 or whatever. It takes way longer to add a wall or two in a door. It doesn't really take long. And if they're off 10%, 20%, 5,000, well, that's an extra $1,000 here and there. It doesn't really matter. The net impact is very minimal. The risk is very minimal. Why I teach this to the main strategy, especially to newer co-living investors, or even those who are like me who want to scale with less risk and are using other people's money. Using other people's money, your number one goal should be doing lower risk investments so that everyone's numbers are as accurate as possible. It doesn't always pan out. It happens, but that's the whole idea of it.
Thank you, brother.
I'll share this all with you, but I hope this very clearly answers it for you. So action items. This is it, right? If everyone's watching, none of this means anything unless you can recap what you got to do. You tell me what you think you got to do, and then I'll tell you what I think you got to do.
As far as making the connections with people and building out the...
No. Like, what's the most immediate things you need to do for this deal right now? You're right. That is part of it. So connect with potential partners. Okay. What else?
Need to, get in contact with your contractor and get him out there, have him take a look at stuff, see what we can do.
Contractor quotes. Okay. Not just mine. You got to get it. Like, you got to get 5 quotes, brother. This is too big of a project to rely on 1 or 2 people, regardless of referrals. You got to get a variety of opinions when it comes to renovations to this extent and the co-living conversion. He might be able to help you with part 2, right? But maybe not part 1. Understand the person doing part 1 and part 2 is probably going to provide you a little bit of a discount potentially because they're doing more work for you just in 2 phases. Maybe not. Like, it just depends. Contractor quotes, so multiple contractor quotes.
So the contractor that I was using he's the property manager on my property that I'm with Dustin and Tracy and them over in Decatur.
No comment. That's up to I don't know. I don't ever advocate or I don't know. Yeah. That's up to you. If that's the person who's going to go all in or you want to do more due diligence. Yeah. Okay. So in my opinion, yeah, you're right. Connect with potential cap partners. I'd put that lower in the list. What you need to do is understand how accurate your numbers are. Multiple contractor quotes, first and foremost, that's your biggest expense. Ask your PML, when is the money supposed to be due to them?
We're already past that point.
Okay, so Either you have to replace them, right, with another prime money lender, which is going to be very difficult right now. Very difficult. Very difficult for PML, right? It's not ideal. You put them in a bad situation. I'm not blaming you entirely. I'm just saying this is the reality of it. This is their money. They didn't get their money. I've lent money to people and they've screwed me over too, and I had to foreclose, and it sucks. It's not great. Most people like me, I was reasonable, and I said, hey, if we can do an extension plan, and we got a clear idea of what's going to be done and how you're going to pay me off, and it makes sense, I'm going to extend. Well, then they took advantage of that too. So, it is what it is. Not everyone's a good actor. You are actually trying to figure this out. Most people are just lazy and don't do anything, or they're willing to take other people's money and then not do the best that they can to try to solve the problem. All right.
Yeah.
Multiple contractor quotes. Okay, so then number one, talk to PML with extension plan. 15% continued, 12-month loan total with clear exit plan. Right? Take care of this person. Don't do that shit. I'm not saying you saying based on my experience of all the people that I've, all the things that go wrong, you'll lend money, they're getting ghosted, and there's not a clear plan, and they don't. I wish you did all this in the beginning, and you might have, but stuff happens. Well, I think you bought the deal a little more quickly than you should have. This is the number one thing to do before you buy a deal, not during.
I mean, you didn't have the co-living stuff out and available at that point in time. So,
and this is such a custom level support. This is a more complicated thing I want people to be doing, especially when they're doing stuff like this.
Yeah.
All right. Get multiple. So then now, okay. So extend PML. That's what this first thing is. All right. Multiple contractor quotes. Oh, so extend PML, validate e-data. So multiple contractor quotes, touch base with lender about ARV, the loan to value percentage, right? If they're still going to do 75%. What else do you need to do? Closing costs, estimate, right? All that good stuff. Great. So you're going to validate key data. Then I would say capital raise. You can't really capital raise effectively until you have some of this stuff done right now, because you got to take care of the account partner you have. You got to get some of this key data, which shouldn't take you forever. While you have this stuff going on, you send a couple messages, you got a few people out there, they're doing this.
Yeah.
Right? Capital raising. So you're going to get, provide, value, CTA, call to action, right? Call to action is who you are. No, is looking for PMP for co-living deal, whatever, right?
Yeah.
Next step, get on a call. So then let's just say capital partner is what I call it in my world. Capital partner intro call. Alignment of people, right? You guys got to be aligned as people, investment strategy, then present deals to aligned capital partners. All right.
Yep.
Send your PML, validate the key data that can mess things up, potentially for you, and the capital partner stuff. Cool.
Yep.
I'll give you all this stuff so you can work with it. I hope this hot seat went above and beyond. I don't know if I can do this for someone else. I gotta how we make this more, especially because I wish I knew the deal stuff a little bit more, so I could have probably saved a little bit of time. Yeah. I hope everyone watching, you got like insane value. I appreciate. I mean, there's dozens of you guys who have been here throughout, and then people have been here. A lot of people have been here throughout the whole time. So I mean, it's a multi-hour thing. Thank you guys, because we didn't just use a calculator. We basically built one for this analysis. All right, cool.
I appreciate it, brother.
I appreciate you. Bye, brother. All right, everyone. This is why I highly advocate that you, when you're starting out with real estate investing, you got to take action. You got to for sure take action. But it's very important to invest in your knowledge and education first and foremost. I'm not even saying invest money. That's why I provide so much stuff for free to people. If you're in the right position, like he said, he wished my co-living community was out because he just invested the money to join that thing. It's super low cost, way cheaper than any other co-living thing, way more value, way more support, whatever, all that good stuff. But invest your time into learning what you're trying to do before you ever invest in a deal. The worst thing you do is buy a deal and then you end up in a situation like this. He's got an out if he can raise the money and all that stuff. He can raise it from a couple people. He's got an out. It's not the end of the world. But if he didn't have guidance from me, what would happen right now is the PML forecloses. They take over the asset. He's wasted all his time, money, and energy. The PML has a property that they don't know what to do with. Like, you're setting them up for failure if you're not investing in yourself, whether it's just time to learn before you take action in real estate like that. The first action is the education. What do you want to do? What do you need to learn? I broke that stuff down in so much detail the last few live office hours. It's there for you. So take advantage of that. I gave you guys all the free resources in my community. It's literally all there for you guys. Here's the link. Take advantage of that. Courses, tools, resources, how to do a lot of this stuff. It's all there for you, free calculators, whatever. He's got an out. We helped him with a strategy. He should be able to figure this out, right? Extend the PML, validate key data, basically the contractor, because it's going to cost them the most amount of money. And it's going to take, how long is it going to take? How much is it going to cost? Touch base with the lender to validate the ARV stuff's still good. The loan to value percentage is still accurate, right? They'll do a 75% loan based on the appraised value, the closing cost estimate. It's all going to play in. When he has those two things, he knows, actually, I forgot to mention, for the capital raise, the first thing he's got to do is define exact capital raise amount, when the money is needed, and where it's going, right? It's kind of the same thing, right? Define the total amount that's going to be needed. When is that each amount needed, and where is each of those going? That's how you provide like clarity and comfortability to a capital partner, so they can say, yes, I understand this deal. It's a lot of money, or it's any amount of money. If it's $10,000, it's a lot of money. Any amount of money, you're telling them, here's the strategy, here's what we're doing, here's why we need the money, here's where it's going. In this context, it's coming in phases. There's a lot more variables. He's got to explain all this, and the better grasp he has of it, the numbers are validated, the timeline's much more made certain, and he's explaining this stuff effectively. It's going to increase his likelihood of partnering with the people that do have alignment. You could have people who align with you as they like you as a person, but they're like, dude, just deal's just like too much of a mess for me to deal with. Connect with people, right? He has his call to action. He's saying he chooses value. Well, let them know you want to connect with them, see if you guys are a good fit, see if the investment strategy is in alignment, then present the deals to these aligned capital partners that have the amount of money who want to do these deals with you, right? They got to have the right amount of money. They got to have the right timeline. They got to have the right understanding if they want to do this. Cool. Hopefully that was helpful. Thank you guys. I appreciate you guys. I appreciate how many of you guys have been here. All I ask for you guys, if you're not subscribed yet, please subscribe. Please like the video if you liked it. I appreciate you guys. Show me some love in the comments, just so other people can get value from this stuff. I appreciate all you guys. If you're not on my Instagram, get on my Instagram. I'd appreciate that too. If you're not taking advantage of all the free resources I have for you in my Real Estate Freedom Roadmap free community and school, take advantage of that stuff. Honestly, at the end of the day, I don't really care if you're part of any of this stuff, but if you want to take advantage of it and want to be notified, that's how you do it. All this good stuff, right? It's up to you guys what you want to do. I give tons of free value, and I hope you guys just take it. Not for me. You do it to change your family's financial future. Like I said, the people watching this stuff, I'm not making viral videos. I'm not here to do TikTok dances. Like, that's not how my content is. If you're watching this stuff and you're hours into this kind of stuff, you're really invested in your learning, you are the right type of person who deserves financial freedom because you're willing to learn. You might need support with taking action. You might need better education, whatever, but you're willing to. You're doing the thing that you can, especially the free stuff. Now it's to put it into intentional action, maybe even get some more intentional education to help you take it to the next level. I don't know where you're at. You guys deserve financial freedom if you're willing to just sit through stuff like this and learn it. Now take action with it. Take advantage of all the free resources. Take action with it. And I hope you guys achieve the financial freedom that you're looking for. So thanks, guys.